Today I will reveal all the secrets of a new concept that is rapidly gaining popularity. This tool is an enhanced version of the Power of 3 theory or the AMD theory. Why? First of all, it is fully algorithmic. This concept can be used on any time frame, which I will explain to you today. This theory suits absolutely any trader, whether you're a scalper, intraday trader or swing trader. You can implement this tool into your trading strategy. I will show you how the CRT range forms and provide examples of how to find high probability trade setups using CRT. Absolutely every candle is a range. Naturally, we won't be working with every single candle. I will teach you how to identify the most probable candles and properly synchronize them with timeframes. For example, to synchronize a daily timeframe, we use a 15-minute timeframe. I will show you later how to work with other timeframes as well. Let's define 2 ways to work with such a range. The first approach, working during the range formation. Every candle has an open price, a low, a high, and a close price. When a candle opens, we wait for accumulation. After that, we expect manipulation and distribution, after which the candle closes. I'll explain later how exactly to trade inside such a range, but I want to emphasize that the internal structure is not important for us while the CRT range is forming. The second approach, working with the previous candle range. Here we analyze and trade based on the already formed candle range from the past. So let's say we have a closed daily candle. The next day we expect a deviation that captures the high of the previous range, depending on the context, whether it's an uptrend or a downtrend. We anticipate a deviation that captures the high of the previous candle and then delivers the price either to the 50% level of the range or to the opposite side of that range. Now let's delve deeper into studying CRT ranges. It's important for us to understand how the candle of the given range forms, how price may interact with the boundaries of a CRT range, and we'll also learn to identify low probability CRT ranges, ones that completely invalidate our idea, and will avoid trading such ranges. Now let's move on to graphical examples and analyze example 1, after which we'll proceed to the charts and see how this theory can be applied to opening positions. We'll also review a few case studies. I want to demonstrate how price behaves within a CRT range using the daily time frame, as I believe this tool is most effective and highest probability for intraday traders. This is because the phases of accumulation, manipulation and distribution can be directly synchronized with the trading sessions that occur within a single trading day. I also want to draw your attention to the fact that we will be synchronizing the daily candle with the 15-minute time frame. I will show you how to synchronize other time frames a bit later. Another key point, to use this tool correctly, you need to learn how to establish daily bias. Let's model the situation. We're in an uptrend, and after a correction ends, we expect a bullish upward daily candle. In this context, applying CRT within the range, we will have the highest probability of success. Now, let's dive into the details. When our candle opens, accumulation typically occurs, and this usually happens during the Asian session. Within this Asian range, sentiments and orders accumulate. This will be the first signal that the CRT is most likely to form today. It is also important to ensure that the Asian range is not trending, but rather narrow, approximately up to 20 pips. The next phase the market transitions into is manipulation. Manipulation aligns precisely with the strong session. For us, the strong session is London or Frankfurt. During this session, we are anticipating the formation of a liquidity sweep. At this moment, the market maker creates short-term liquidity by sweeping the stop losses of buyers who entered during the Asian session, thereby pushing them into short positions. Upon reaching a key level, such as an order block or similar, our manipulation concludes, and we can then expect expansion, the third phase of AMD. Distribution. This is where we can consider our first entry into the position. After distribution occurs into the New York session, we then look for either a correction or a continuation. If a correction occurs toward the high of the Asian range, this presents a second opportunity to enter our position, as we are expecting a bullish candle today and have clear targets for our further movement. Entering a position will be safer because you will already be working with order flow signaling a continuation. This is exactly how the CRT candle should form intraday. This is how you can use it. Next, we look at a real chart examples so you can understand how to do this. Now let's examine the second way to work with CRT range. If in the first case we worked with the range as it was forming, now we're interested in the boundaries of the previous range, that is, the high and low. In that case, depending on the context, which in this instance is a downward trend, we will wait for the capture of the previous range's high, followed by consolidations either at the equilibrium level or on the opposite side of the range liquidity. Let's break down a graphical example together and see exactly what we need to focus on. I will also provide an example on a daily chart and use a 15-minute time frame, as I believe the CRT tool is most reliable for intraday trading. Before we start looking for a position, what's important to identify? Naturally, it's the range boundaries, meaning in the case of daily chart, the previous daily high and the previous daily low. It's also crucial to find a support resistance pivot point from which we'll open our position. This ensures that our reversal trade isn't just floating in the air but has a solid structural foundation. A pivot point can be absolutely any zone of interest. It all depends on what you use. It could be an order block, a rejection block, or some kind of inefficiency. Now let's focus on what we want to see during the formation of the next day's candle. When the next day opens, we want to see consolidation during the Asian session. Specifically consolidation because this is where orders and sentiment accumulate. The narrower the range, the higher the likelihood that we'll see manipulation in the opposite direction of our bias, in this case the downtrend, and the higher the probability that we'll get a strong exponential move. After the Asian session concludes, we move into the next phase, the manipulation phase. This manipulation typically occurs during a strong session, namely the London kill zone. During this phase, we often see the formation of liquidity sweeps, in other words, market manipulation. What is important for us to see in this situation? We need to see the capture of the previous day's high, but since we won't be catching the reversal purely from liquidity, it's important for us to see a support point. This could be any level. At this support point, we wait for confirmation that the swing low is complete, meaning the formation of a smart money reversal on lower time frames, such as a 15-minute or 5-minute. After such reversal forms, we open our short position, and the first take profit level will be either the Asian session's low or the equilibrium level. This is the highest probability scenario, as we cannot know for sure where liquidity will be taken out that day. If you want to open a position for a larger risk-reward ratio, targeting more global objectives, then the logical take-profit level would be the previous day's low. Now, let's discuss the third possible scenario of the formation of CRT range, namely its invalidation. Why is this important? Since we are looking for high probability moves and aim to grow and protect our capital, we are only interested in ranges that are more likely to play out as expected. Therefore, let's examine the situations in which a range should not be considered for trading. In such cases, we either skip that range or even skip the entire trading day. The first and most critical criteria for invalidation our trading range is exponential order flow. If the Asian session opens with strong aggressive order flow and a powerful directional move, we do not expect a reaction from the upper or lower boundary of CRT. In this case, the previous day's high. Similarly, if we identify the formation of an MMXM pattern, we should not anticipate a reversal at the previous day's high. Also, the third piece of information, which is very important, is that if we lack a reference point, it reduces the likelihood that our range will play out. That is essentially, in these three situations, if we see such a price formation, such a price action, we no longer consider the CRT range for trading within, and instead shift to anticipate the next trading scenario. Now, let's learn how to identify the most probable ranges and synchronize timeframes for trading within them. We will work with just 4 ranges: monthly, weekly, daily, and 4-hour. You can also use lower timeframes, but the probability of these ranges playing out will be much lower than with these 4. What do we need to do? If we are trading within a monthly candle, we use the 4-hour time frame. Here we look for consolidation, here we see confirmation, and here we analyze the structure. For the weekly time frame, if we trade inside a weekly range, we use 1 hour. For the daily, it's 15-minute. This is the time frame I'll use for my examples. Additionally, if we are using 4-hour chart, we trade on 5-minute time frame. That's why we use these specific timeframes to identify the most probable ranges. Now let's look at real-life examples together. To determine the highest probability range, we need to identify the market context and its narrative of movement. Let's break down a situation that occurred on euro-dollar. Here, we see the local formation of a range. Price became trapped inside it, after which we witnessed liquidity being taken on the sell side. This sweep led to an aggressive displacement, driving price toward the buy side liquidity. At the same time, during the shift, we observed predominant buying volume, indicating that the market has shifted and we can now expect a long biased context. But the question remains, where exactly should we look to open our position? Naturally, we want discounted prices that are most likely to appear in areas of inefficiency. typically in the form of gaps. This is why we now need to clearly define the boundaries of our CRT range, the zone we'll be actively trading within. Since we are working with the daily chart but synchronizing it with the 15-minute time frame, we'll switch our focus to the 15-minute chart. To properly determine our trading approach, we need to utilize two key tools: the daily candle indicator and the session indicator. Let's scroll forward slightly and observe the market behavior at the daily open. Notice how during the Asian session we see clear accumulation. There is no expansion yet, just liquidity building up in what appears as a low resistance liquidity run. Now we'll be waiting for the London session to open. Here we see the London Kilzo opening, that is the Frankfurt Open. Now we are anticipating manipulation, specifically the formation of a Judas swing. This manipulation will take out the previous day's low, just as we've examined in our examples. At the same time, we have our anchor point in the form of daily inefficiency. The daily inefficiency appearing as a gap. Now it's crucial for us to wait for buyer side displacement before looking for our entry. We've waited for the Judas swing to complete, and now we're seeing the formation of a smart money reversal. In this scenario, we'll be entering positions from areas of inefficiency. I would prefer to either trail the position, partially taking profits at equilibrium, or hold it all the way to the previous day's high, especially since we are seeing a substantial liquidity cluster here. So in this case, we might attempt to ride the position like this. Watch how price immediately reacts when reaching equilibrium. After hitting this equilibrium during distribution, we got a retracement, a pullback to the nearest inefficiency zone. Since we didn't witness the sweep of external liquidity, we'll be closing our positions at equilibrium. Naturally, there is a significant probability price might reach external liquidity, but since we close positions within the same trading day, it ultimately depends on your trading system. One could alternatively wait for the next liquidity sweep to materialize. Let's move to the second example. Now, we'll examine another scenario: the formation of a CRT range during candle development and how to trade it. Here we can clearly see a fully established uptrend. In my view, the targets are obvious. We are looking at a buy-side liquidity. Since price is being delivered through institutional order flow during this markup phase, we anticipate another bullish candle to follow. This zone has already reached a rebalanced state, meaning we shouldn't expect a pullback to this breakaway gap. The nearest price target is this level here. Now we'll switch to the 15-minute time frame and wait for the Asian session open together. Let's observe what develops during Asian trading hours. Let's pause here as we are approaching the London kill zone and watch what's developing here. We're seeing a range formation during the Asian session, precisely that accumulation of orders and liquidity pools we've discussed. Now we're looking for the formation of a Judas swing, that manipulative move that sweeps short-term buyer side liquidity. We can observe the formation of a Judas swing during the London session, but we need confirmation through structural displacement. Currently, we haven't seen the structural shift yet. The next candle will confirm whether this displacement occurs. At this point, we either execute a market buy order or place a limit order, and then await the next phase, the distribution stage. Our conservative targets would be either the previous day's high or the final projected price objective. This depends entirely on your trading system and risk management parameters. After entering the position, we monitor its development, but as day traders we strictly operate within a single trading session's time frame. What I want to draw your attention to is the critical importance of highlighting market context. It's essential to identify accumulation during the Asian session, after which we will always anticipate manipulation and distribution. The greater your trading skill and the more tools you employ, the easier it will be for you to pinpoint reversal points. You can use other time frames, but the 15-minute time frame synchronizes perfectly with the daily one. And within this theory, it operates as follows: daily to 15-minute, 4-hour to 5-minute, weekly to 1 hour, and monthly with 4 hours. I'm confident that this tool will serve as a valuable addition to your trading strategy. Congrats on making it to the end. As a reward, I'm sharing my 3 favorite trading strategies, ones I've personally used for years with consistent success. These are unique, so I doubt you've seen them before. Give them a try on a demo account first. The full guide is waiting for you in the PDF linked below. If you enjoyed this, show some love by liking the video and subscribing to the channel. Thanks for watching and catch you in the next one.